Well, the leadership on the upside has obviously been the technology sector, okay, and now lately AI, okay. And that's why the NASDAQ 100, which is focused in that area, has gone up way more than the S&P 500 since 2009, okay, sevenfold versus 18-fold. So it will lead on the downside in terms of percentage decline. But it will be broad. It will not be narrow. In other words, if the market goes down, it's going down. It won't just be tech sector. So people who think I'll go over to this sector and be okay, no, the whole thing's going to go. The only question is which sectors go more. Uh, we know that last year, for example, the banks spooked many people. We had a little crash in the bank sector, the U.S. banks. That would be March of last year. Uh, and that's sort of gone by the way, and the banks have stabilized. They're not back at their highs. Okay, S&P may be because of a few stocks in the S&P, and same with Nasdaq. About 5% above its old highs. But a lot of sectors aren't. The banks aren't. But so everybody's sort of watching the banks. I think they should broaden their view. There's other sectors out there that, from our unique technical perspective, show pending vulnerability and surprising type vulnerability, meaning when they start to break, they could break quickly and deeply. One of them, for example, is the healthcare sector. It's a sector that very few people are looking at as being vulnerable. So, and that's the kind of stuff that happens. That's when people get panicked because they didn't expect it.
In today's market recap, Indian silver imports surge to record levels. Indians are known to have a love affair with gold. India ranks as the #2 gold-consuming country in the world behind only China. But Indians are also pretty fond of silver. In fact, India is the world's biggest silver consumer. Silver imports skyrocketed by 260% in February, hitting a record high of 2,295 tons. That was up from 637 tons in January, according to a report in the Economic Times of India. The Times said this surge in Indian silver buying could support global prices trading near their highest in 3 years. To put the import surge into perspective, India imported 3,225 tons for all of 2023. Indian imports are cyclical in nature. In 1 year, imports may be very high, and then the following year they may fall. Since imports fell in 2023 after record buying in 2022, we can expect imports to pick up in 2024. Industrial silver demand is projected to rise 8% to a record 632 million ounces this year, pushing overall offtake to near record levels. According to the Silver Institute, investment in photovoltaics, power grid, and 5G networks, growth in consumer electronics, and rising vehicle production all helped drive industrial demand higher. On the supply side, global mined silver is anticipated to fall by 2% year on year to 820 million ounces, driven by lower output from operations in Mexico and Peru. Silver isn't priced for these supply and demand dynamics. This could present a great investment opportunity. Now we'll show you the best clips of the latest interview. Hit the like button, smash the subscribe button, and turn on notifications so you do not miss out our daily videos. Enjoy the episode.
Okay. Well, it's really an issue ongoing over the past century, Federal Reserve, okay, where you get these boom-bust cycles, especially in the stock market. And it's usually directly connected to monetary activities by the Fed, both the artificial interest rate levels that they create and river flows of liquidity. And quite often investors will flow that river into the stock market. Now, there's times they won't, and that's something people need to realize. But we think that the bubble that was just created, stock market bubble, in the U.S. in particular, is the biggest in U.S. history in terms of, one, age of the bull market, and two, the dimensionality of it. For the NASDAQ 100, since 2009, a lot of years there, 18-fold gain. For S&P 500, 7-fold plus gain. You go back and look at 1923 to 29, 1994 to 2000, 2002 low to the 2007 high in the U.S. Those were doubles and triples, and they lasted a handful of years. So they were both shorter and less dimension. Therefore, the embedded distortions that have occurred during the bubble are worse, will be worse, and once the bandage gets ripped off, the pain will start to flow. A lot of the errors that are committed aren't just macro errors, they're family type errors. They're municipal government type errors, company errors, where spending decisions, commitments to do this or do that, build a new home, add to the factory, hire more workers, et cetera, are based on variables. But one of the main variables in anybody's decision process is what is the cost of money? That's a major factor. And if money is effectively free for a dozen years, it had one little blip where the Fed funds rate went from like 0 up to 2.3, and then they yanked it right back down again. We call this filling the tank, which the Fed is filling the tank with liquidity, and the primary beneficiary was the stock market, especially the US stock market, more so than any other, certainly more than China, more than Europe, and so forth. So we have the biggest bubble. So far, when you look at the price chart, most people don't perceive that it's broken. Our analysis, momentum analysis, suggests that in January of 2022, it broke. But most topping processes in the stock market, when you go back through history, well, you take the 2000 top. We got bearish in January of 2000. It didn't fall apart till January 2001. Labored up there, even made marginal new highs above when we said sell. 2000, late 2006, the market was starting to top. If you've ever seen the movie The Big Short, the guys who anticipated what was going to happen fundamentally in the real estate market were right, but they didn't know how to time it. In late 2006, we could see that the market was going to top the next year, and we forecasted that the high would be probably between 1550 and 1600, which was an all-time new high for the S&P if it got there. It had still been confined below the 2000 top. Well, it labored all year long, 2007, up and down, and then finally punched through that high. The Fed had cut rates in mid-September of 2007, the first rate cut in years, by the way, back then. Market top 4 weeks later. In other words, if you'd shorted when the Fed cut rates, you nailed the top. Same occurred in 2001, January 2001, as the market was coming off the 2000 highs. They cut rates, market collapsed. So everybody who's now cheering in the US, oh boy, they just cut rates, oh boy. Historically, it's not a good idea because when they cut rates, they're panicked. Anyway, we think that there's a good reason for them to panic. When that bubble breaks, all kinds of errors will be exposed in all kinds of arenas, not just in the stock market. And because of the dimensionality of the bubble, the consequences should be huge. I think gold knows that.
In today's news recap, silver to ride coattails of gold's record prices. Silver has the most potential to benefit from a sustained rally in gold among the precious white metals, reckon UBS analysts. Silver has started to gather some attention in early second quarter following the relentless rally in gold to new all-time highs. With many investors caught off guard by the speed and magnitude of gold's ascent, silver has been offering market participants a chance to catch up. We think it is still early days, with silver's year-to-date outperformance still relatively muted compared with its historical behavior. Investment demand and green technology trends could help to drive silver's demand. UBS added, as could wider risk on sentiment in the wake of interest rate cuts, while higher volatility is likely to also attract more active investor participation. Now we'll show you more clips. Like, subscribe, and share this video with a gold bug to support the channel. Let's get back into the video.
An event last year, which we called, it was the summer of last year now, I'm talking, T-bond futures market we were looking at, as 30-year maturity, which is the end of the market that the Fed has least control over. They have more control over the very short term, the overnight stuff. But the way long end of the market, they have some influence, but they don't have total control. And we could see there was a crash coming. We called it a nuke event. And sure enough, between August and October of last year, the T-bond market went down savagely, speedily, almost crash-like. In fact, it went down where other bond markets, like let's say corporate debt, municipal bonds, they went down too, but they didn't go down in crash-like dimensions. So what does that do to the Fed? Well, and to Secretary of Treasury? Panic. Now they can't admit panic, because you do that, then you enhance the panic, okay? But you know they were panicked. And we expected a V bottom at that point, meaning that yields would peak, prices would bottom in T-bonds, and we'd rally. We did. Rallied like a little ballistic rocket ship coming up out of the hole. Into December. Nice move. Then it halted, and now we've been in an arm wrestling pullback. The question is, what's next? If the T-bond market can rally about 4 or 5 points, not yield points, but price points. Right now we're trading in the 117s on T-bond futures. You get up in the mid 122s, and you're going to break them out on our momentum work, meaning yields will drop. Question is, when is that going to occur, and is there more pain, meaning somewhat higher yields, lower prices before then? Can't answer that right now. But I can say they do have the potential to turn up. Now, what does that mean? As you know, there's the 60-40 portfolio rule. You know, if you own 60% stocks, balance it with 40% bonds. So, well, that you got killed in 2022 if you had that portfolio. In fact, T-bonds were down more than the stock market was. But historically, there is, for instance, in 2007, when the stock market peaked, started down, bonds took off, upside, yields dropped. Gold took off too then. Similarly, in 2001, when the stock market started to really start its bear trend, bonds turned up and price down, and yields, gold went up. So T-bonds and gold were sort of in link at those points in time. And what it means is that some asset managers saw that the risk in stocks, too high, too risky. Let's move some portfolio percentages over to an alternative. And the alternative was perceived at those times as T-bonds, debt market. And it was right. Okay. This time it may be right too, but I don't think it's going to be sustainable right, meaning if there is a fracturing of the stock market that people recognize, meaning in price, there's already nervous portfolio managers out there. We hear them. Yet they're long. They have to be. You can't not be long. You lose customers if the market's going up. So they're long, but they're doubtful. You can bet when that market wobbles, and we expect it to commence very soon, price-wise, give back the, quote, marginal new highs that a few indices have made. Most market indices haven't, but the S&P and Dow have. At that point, you're going to have some movement over into two categories. We're already seeing one of them right now. That's the gold market. And the gold miners, by the way. But I think you could also see it at some point in the T-bonds, meaning a drop in yields. But it's simply a function of panic. I wouldn't look at any currency. Yes, they compete with each other. And the dollar is up versus the euro, and therefore recently the dollar index has been up. The dollar index is a meaningless concept. It's 57.6% euro. It's hardly an index, okay? It's a euro inverted, okay? It's the degradation of the money units in general. And if you look at an M2 chart of on the Federal Reserve site in St. Louis, go back 50 years or so, basically every decade, the money supply almost doubles. Regardless of the decade, regardless what happened that decade, the money supply basically doubles every decade. What does that mean? It means your buying power, gets wiped out every decade. So if you bought a stock at $10 and 10 years later it's at 20 and you think you're making money, no, you're not. Okay. When I was a little kid, a loaf of bread was under 20 cents. What is it now? Okay. So it's ongoing degradation of money. But I think what gold sees here and what it's done over the since it was legalized in the U.S., it went from 30 something to 200, then to 850, then to 1920, and now we're 2350. Why does it keep going up? Because money continues to degrade. But the question now is, if you break that bubble, paper asset bubble that we just talked about, the Fed will panic. They may say, oh, we're out fighting inflation. Well, they're going to have a real problem there because, yes, the Bloomberg Commodity Index, for example, is starting to reassert itself again. And I think we're starting a second leg up in commodities. So presumably the Fed would therefore do what? Maintain higher rates, not cut. Of course, the stock market doesn't want that. But if the stock market starts to break, there's the other thing that the Fed has, the other mandate, and that's employment. And employment numbers, frankly, have not looked good. Which all the last 3 or 4 months, they keep showing these, oh, job growth is great, but it really isn't. It's part-time. It's in healthcare and home care services. It's in hospitality, and it's especially in government hiring. So all the main sectors of the economy are flat to down in terms of employment. So it's really getting, but once that data point changes, the Fed will be pressured two different directions. And I almost guarantee you they'll panic to defend the paper assets. In which case, what does that mean? That means any tightness we may have seen over the last since March of 2022 is gone. They're going back to loose policy. That's what gold lives on. And gold knows it's coming.
What do you think of Michael Oliver's forecast? Is the gold and silver rally over, or we're just getting started? Post in the comments section if you're buying at these prices, of if you're rather cashing at all-time highs. Share this video with a gold bug and watch this episode right here, because it is a perfect fit for you. I see you on the other side.